Now, Blue Apron may not be a big company, but the US-based meal kit delivery service has come to represent much of the excitement surrounding the tech sector and a lot of what's wrong with it. Now, investors are worried it will face intense competition from Amazon, which recently purchased the Whole Foods supermarket chain. And so far this year, Blue Apron is the worst performing large initial public offering. On Thursday, the company reported a net loss of $31.6 million for the second quarter. It made a profit of $5 million in the same period last year. The latest result translated to a loss of 47 cents per share. That was worse than analysts had forecast. Blue Apron shares have fallen more than 40% since they debuted in June on the New York Stock Exchange at $10 each. They touched a record low on Thursday. Investors say they're concerned the company's business model is not sustainable. Its marketing expenses tripled over the last 2 years as it tried to attract new customers. So for more on this, let's join Santosh Rao from New York. He's the head of research at Manhattan Venture Partners. Santosh, great to have you with us on Money Talks once again. Tell us a little bit more about Blue Apron. Who are its main customers? Who buys these meal kits?
Hi, thanks for having me. Well, Blue Apron is a play on a secular future trend. The stock selling off today is not a surprise. The risks were very well telegraphed, so I don't think investors should really be surprised. They came to market very early. They should not have IPO'd so soon. It's still half-baked, so to speak. So there are a lot of issues there. But I think they came out, they needed the money, so they couldn't wait any longer. But in the end, on a demand side, it is in the right space. It's a growing market. Grocery business is a huge market. It's a $6 billion market. The online is the penetration is very low on the online side. So I think their market is there. The competition is intense. Amazon has just come on, but I think there are other niche players who they compete with. But the market, the demand for Blue Apron is big. You have the new millennial population that wants food on the go. They want fresh food. They want healthy food. It's good for the environment. So I think there are a lot of issues that work in favor of Blue Apron. Now it's an execution issue. We'll see if they can execute in the face of intense competition.
Now, one of the big concerns surrounding this company is the rapid rate at which it's burning through its cash, as its expenses seem to be much higher than some of its competitors. Compared to other tech firms at this stage of their development, is that rate of cash burn relatively high?
It is relatively high. You have to go back a little bit. Blue Apron wanted to raise close to $3 billion. They could not. I mean, the IPO did not go very well. They priced way below what they wanted. So they barely got $1 billion out of the whole IPO process. So they're short of funds. So they need that. But cash burn is very normal, especially for a disruptive company such as Blue Apron. They have a lot to do. They are pretty much developing the market. They are a leader in that market, in their sector. So they're going to require a lot of investments in marketing, in sourcing, and so many other things. So you will see that they will burn. They'll have to raise more cash down the road. So investing in Blue Apron is a bet on the future. Can they raise the money because the market opportunity is there? Can they survive? And I think it's too early to write them off. They still have a chance. They're a good player in that niche market.
Some people have compared Blue Apron to the Uber of this relatively new market, meal kit deliveries. Is that a fair comparison, do you think?
Yeah, yes, it's a fair comparison. They're different verticals, but I think they're pretty much the same thing. It's a very convenient service, very well loved by the people. So they're both very good. They're both here to stay. Blue Apron may be in a different shape under a different umbrella, but in the end, the meal kit business is a growing business. And just as a ride-hailing business is a growing business, it's part of life. It's changing lifestyles. So I think you can say that. It's a pretty close comparison to Uber. In that sense.
Okay, now Blue Apron is coming up against some stiff competition. It's got competition from people like HelloFresh, a German company that's actually taking away some of their market share on its home turf. Also, Amazon, as we mentioned earlier, with its acquisition of Whole Foods. We've seen a lot of copycat activity amongst the big tech companies like Facebook and Google. They've been copying some of the applications of smaller tech entrepreneurs, and we're seeing a similar sort of thing happening with Amazon. Is that a real existential threat to Blue Apron from what Amazon is doing?
Yeah, I think at this point, it's not a zero-sum game. It's a growing market. And just because Amazon is in there does not mean they will get the market. They've tried different businesses. All the big FANG stocks, so to speak, the big, very well-capitalized internet companies, they're throwing money around. They really don't want any competition to come, or they're entering new markets. So it does not mean that they will succeed. Blue Apron can still continue and survive very well. And Amazon, it's still very early. They're trying out this market. They're only in about 14 or 15 markets so far, only in the coastal areas. So they still have a long way to go. Whole Foods helps in the last mile, in the sourcing, and other areas. But I think Blue Apron has a jump start on all of them. They have close to 1 million customers. They're growing. Their supply chain is pretty good. They're very well plugged into the farmers and the local suppliers. So I think Blue Apron has a lead on them, but they need the resources. They need the financial muscle. So we'll see if they can survive. I think at this point, it's 50-50 whether they can survive. But I think there's definitely a market, and it's their market to lose.
Great. Santosh Rao, Manhattan Venture Partners in New York. Thank you so much.